Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today, in some sense, is fairly unique because we're talking about 2 or 3 very recent talking points. I mean, effectively, these are indeed the talking points of the session today or of the next few days. And if you just look at any of the things that we're talking about, be it what's happening in the EMS space and the resultant semiconductor push, be it SMIDs likely to be under pressure, it's a question that we're asking because of all the caution that is being thrown around, or be it the possibility of rate cuts at some point of time, bringing in FPI flows as well. Well, to talk about all of that, the perfect guest, Pramod Gubbi of Marcellus Investment Managers. We will no doubt talk to Pramod about some of their pet themes and what their views are on those. But Pramod, thanks so much for taking the time out and speaking to us. Lovely having you as always. Let's start off with whether the GDP print, the global cues, etc., make you sanguine about the prospects of our markets, or are you circumspect because of the valuations being high when one looks at the current year earnings?
Yeah, sure. I think, this is the point that we've been making that on the economy, clearly a lot of things are ticking the boxes. But as history suggests, the economy and the markets don't necessarily have to go together, particularly in the short run. In the long run, of course, economic growth supports corporate earnings, which in turns drives returns in the stock market. But in the short run, they can be fairly disconnected. If you take the next 3 to 5 years, I think the economy is in pretty good shape. There's absolutely no doubt about it. We all have to feel sanguine about it. But from a market standpoint, I think the markets tend to be forward-looking, and therefore there seems to be a lot of pricing in of these positives from a valuation standpoint. Given where we are, I think it's the next leg of growth will come when the promise of the economic growth translates into earnings growth as well. Remember, the last 4 years have been fairly unique in terms of the shape of the economy, given what all we've been through. The disruptions around COVID and lockdown and the massive rally in commodity prices, which put pressure on corporate earnings, and the deflation that's followed. So therefore, we haven't really had a clear period in terms of earnings growth to make a proper assessment of companies' balance sheets and earnings growth. So I think going forward, that will be the trigger. We'll have to fulfill the sort of expectations that the market has in terms of these earnings growth coming through. And corporates have to deliver that to justify the valuations today. Of course, there will always be pockets of mispricing in the market. That's what makes the markets interesting. But at the overall level, I reckon this is a reasonable assessment that the economy is in good shape. The markets are factoring that in. We'll need to see delivery in terms of earnings growth.
Pramod, the missing element for 2023, you could argue, was the participation from foreign institutional investors. Now, it could be an EM factor. And the reason I ask you is not by virtue of the previous hat that you wore, which was, managing so many FIIs, but also the fact that you guys currently at Marcellus have a fair degree of global money coming in through your funds. What's your sense? When do FPIs make a comeback? Will it be dependent on China improving its performance and therefore EM as a basket getting money, or is it something else?
Well, I think it's a mix of a few things. The overriding factor has been the reallocation from China to India. That's ongoing. I don't think we've seen the proper beginnings of it. That will continue to play out over the next 3 to 5 years, because as we speak to allocators, we get a sense that there is clear interest in India as the next big economy to bet on. Many of them have been heavily invested in China, and China hasn't particularly delivered in terms of returns. The policy changes have left them wanting. Now, if you look elsewhere, there are not too many alternatives which match up to China in terms of size as well as the growth dynamics, which is where the interest in India is growing and is in structural in nature, and we haven't seen the beginnings of that. That's perhaps likely to pan out over the next 2, 3 years, because it's unlikely that that money will come through emerging market funds, because then exposure to emerging markets would mean that investors would get the same exposure to China. Instead, what we're seeing is people looking at India dedicated managers like ourselves and a whole host of other managers to get exposure to India. To that extent, they're preparing, they're doing the homework on India. At some stage, they will be in a position to press the button. The biggest hindrance to them making that call has been around valuation. Remember, India stands out in terms of its earnings multiple compared to most other emerging markets. It's always been the case. We have always traded at a premium compared to other emerging markets, and more so today. For them to make sense of why this premium exists, and therefore it makes sense to press the button now, it might take some time. In the interim, of course, there will be shorter term flows that might be dependent on interest rates. Although I'm not sure, given the sort of economic data that we're getting from America, particularly in terms of jobs data as well as wage inflation, I'm not sure if the Fed will be rushing to cut rates. There are pockets of the economy which are slowing down. We're also seeing that data in exports of Indian companies. Having said that, it doesn't seem like the situation is so dire that there is a desperate need for a rate cut. But should a rate cut happen, we can expect flows to pick up. But these are not the structural kinds. These could come in quickly and go out quickly as well. But the structural story around reallocation from China to India is the biggest driver we need to watch out for from a 3 to 5 year perspective.
Rate sensitives, Pramod, we talk about that every time with you, maybe because of the Kings of Capital portfolio or otherwise. I'm just tweaking that a little bit because it's pertinent today. Auto sales numbers, the way they've come out, and the way they've come out for the last few months, also how the auto index has fared for the last few years. I mean, it's had a positive return almost every single year since 2020, if you will. The numbers for February thus far as well don't look that disappointing for two-wheelers in particular, maybe for passenger vehicles as well. Now, juxtapose this. Economy buoyed no doubt by tax buoyancy, but 3 quarters in a row, economic print is okay. But the economic-linked CVs or tractors not quite doing well, but passenger vehicles and two-wheelers doing well. How are you looking at the auto pack per se?
Yeah, no, it is a bit of mixed data, even including the GDP print that we saw yesterday. Consumption clearly is not firing, but at least the second derivative seems to be changing, where it seems to have bottomed out. That doesn't tie in with the sort of exuberance that we've seen from consumers in terms of purchase of passenger cars and two-wheelers. There is an element of new launches which drives auto sales as it is, and we're seeing the auto industry, especially the cars and two-wheelers, being in a sweet spot on that front in terms of the launch cycle. That clearly is driving. And also, I think the banking system being flush with capital is also supporting credit-driven purchases, whether it's automobiles or mobile phones and so on. So to that extent, there is support from the supply side, which seems to be offsetting any sort of weakness, because discretionary consumption in general, which is where autos would come in, isn't particularly firing on all fronts. So there is specifics to the auto, especially remember two-wheelers had been through a long period of lull in terms of growth. So there is a little bit of bounce back. Plus, the other supply side factor has been the emergence of electric vehicles or electric scooters, which is again pushing through some of these positives as well. So to that extent, I think it's not that straightforward that we can see sustainability in terms of growth on these fronts. We'll keep our eyes and ears open on this sector. Our play has been around luxury, because clearly one aspect of consumption that has held up has been the high-end spending. So our exposure to two-wheelers has been through iShares, which makes the high-end bikes catering to the more well-off in the country. That's done well for us. But for the rest of the sector, we'll continue to keep our eyes and ears open.
Okay, well, keep eyes and ears open on most counts really, and for any conversations around how Pramod thinks about the rate sensitives, both lending and non-lending financials. A previous conversation could also be good because they invest for the slightly longer term and not very short term. Quickly run through a piece of news that came in earlier today, or maybe late last night. CG Power signed a joint venture agreement to build and operate an outsourced semiconductor facility in India. In fact, the Indian government has cleared 3 semiconductor facilities in addition to all the work that has already been done. Mihika joins us with the details. Mihika.
Yes, so CG Power, which is a equipment manufacturer, along with Renesas Electronics Corporation, which is a semiconductor solution provider, and Stars Microelectronics, which is a Thailand-based OSAT provider, have come together for a joint venture. Now they build and operate an outsourced semiconductor assembly and test facility in India, in Gujarat specifically, and this was approved under the India Semiconductor Scheme yesterday. Now CG Power will own 92.3% of the joint venture, while Renesas and Stars Microelectronics will own 6.8% and 0.9% respectively. The joint venture plans to invest a total of 7,600 crores over the next 5 years, and it will be financed via a mix of subsidies, equity, and potential bank borrowings, that is if required. Now, the plan is to set up a manufacturing facility in Gujarat, which will have a capacity of 15 million units per day, and they will, produce legacy packages and advanced packages which will cater to the industrial, consumer, automotive, and 5G sectors together.
Well, thanks a lot for that, Mihika. The stock was active today, and Pramod, it's interesting, that the kind of push that the government is doing on some of the things that relative to maybe some of the other nations who had an earlier head start, we were lagging, but now we're kind of trying to make amends for that. What do you make of this push around semiconductor, the policies, the parks that are being thought of, so on and so forth?
No, I think it's a great initiative, and in some sense, I don't think we have any other option because there is a strategic importance to this sector, given the ubiquity of semiconductors in our lives, whether it's in consumer electronics or defense, there is a strategic reason why we need to become self-sufficient on that. And also from an economy standpoint, given the sort of import bills that we get on our consumer electronics, consumer goods, there's also another reason why we need to build that capacity in-house. Plus, I think we're due for a big pickup in manufacturing. That's been the case with this government, with a lot of initiatives around pushing manufacturing, both for self-reliance, import substitution, and also job creation. To that extent, getting into something as high-tech as semiconductors fits into that initiative as well. So multiple reasons to do this. It's a phenomenal initiative. It's not easy. I think we need to hold our horses, but given where we are starting from in terms of 28 nanometers, not particularly cutting edge, there's plenty to be done there and where we have the capabilities. But hopefully over the next few decades, we can move up the value chain towards the cutting edge semiconductor manufacturing and become, powerhouse in semiconductors globally. But it's a great beginning. I think this is something that the economy and the country needs from a long-term perspective.
Most certainly. Okay. The other thing is, we mentioned about consumers and how consumption is weak, and presumably because of the large competition coming in, paints, Pramod, the last 2-3 months actually have taken a bit of a hit. I was looking at the performance of Asian Paints, the benchmark, right, which you guys probably still have in your portfolio, or maybe you don't, but at least you used to. An underperformance of 18% to the Nifty is not something that we are used to seeing Asian Paints do, because it's been this bedrock of performance all through the last decade and maybe even for the last 2-3 years. There's this wonderful chart that we have about how the multiples of Asian Paints have gone through the roof since 2012. And suddenly, Pramod, we find Asian Paints is available at valuations that it last traded at back in 2014. Now, my question to you is, are these concerns overdone, or is it fair to be concerned considering that the paint sector hasn't seen a deep-pocketed, large manufacturing competitor come in a really long time?
Yeah, I don't think there are easy answers. I think the two extremes are easy to bear with, that new competition will come in and disrupt the whole thing. Nor is it fair to say that, look, Asian Paints has successfully faced competition throughout its history and will be able to overcome this easily. Truth, like always, lies in the middle, and that's what makes our jobs easier to figure out. On balance, where does this lie? Um, it's not true that there hasn't been a competitor of this nature. Remember, Sherwin-Williams, the world's largest paints company, came to India and couldn't compete, or for whatever reason left the country. This has always been the case, and this will always be the case. If you want to invest in businesses which make lots of profits, you'll have to be prepared to face competitive entry. Remember, that profit pool itself is a magnet for competition. Nobody would like to enter an industry where the incumbent doesn't make money. So in some ways, the continuous entry of new competition in this sector is testament to the attractiveness of this industry. And the fact that the incumbents have managed to hold fort, not just hold their market share, but also increase market share over time, also indicates the presence of entry barriers. Why have some of the world's best paints companies struggled to compete in India? This suggests there are certain moats or sustainable competitive advantages. And from our assessment, a lot of the moats lie on the supply side, supply chain rather, where it is a hard product to distribute across the country with so many SKUs. So you need plenty of data to drive efficiencies in the supply chain, which in turn are passed on to the dealers. The dealer economics become far more attractive, and that's what the incumbents have done to hold fort over the many decades that they've operated. Having said that, never say never. The next big competitor could have tricks up the sleeve, which are very different from those who tried to play this in the past. Our job is to keep our eyes open and see what those initiatives are, whether they actually threaten the dominance of the incumbents from the past, or will they continue to face challenges like the competitors of the past have done. The market seems to be suggesting that indeed this will be a tough ask to defend. Having said that, the market could also simply be saying that, look, until unless we figure where this settles, would rather stay out of it, which is why you're seeing this play out closer to the launch or the entry of the new competitor, while the news was out for a couple of years now. In fact, the stock hadn't gone anywhere, but the correction has been much sharper in the last few weeks around the launch time. Our job is to act on data and evidence rather than anticipation. Like I said, it's easier to take the extreme stance and say that, look, we're not really concerned about it. Our job is to be concerned and watch it. But at the same time, we can't simply say that the competitor has come in, so let's get out of it. We'll need to make a more objective assessment of the situation.
Just wondering, Pramod, 60-second answer because we're out of time. But do you fear multiples, margins, and ROCs for Asian Paints and the Bergers, etc., coming under pressure?
Yeah, in the shorter term, yes, obviously, you've seen the actions from these players already, right? They've already started cutting prices. But to the extent they've already preempted some of these, they have invested in backward integration by bringing in manufacturing in some of their supply inputs in fold, which adds a few percentage of the margins, which becomes a little bit of an armor for them to cut prices without compromising on the margins. But having said that, I don't think we should expect status quo. A competitor of this size, a capacity addition of this size, should definitely have some impact on ROCs and margins in the short run. But the longer term trajectory depends on how the incumbents react. Like I said, I've shared one of the strategies in their arsenal, which is backward integration. Some of them invested in new growth lines, which could offset some of the loss of market share or ROCs and margins crunching.
Right.
Therefore, longer term, we still remain quite positive.
Got it. Pramod, Gubbi, so good talking to you. Thanks for taking the time out and being with us on the show today. Really appreciate your time. And viewers,
thanks for having me.
Out of
Pleasure
time completely on this leg of the talking point. Thanks so much for tuning in.